Visionary Investor Podcast. I'm your host, Andrew Marks, and I'm a stock market wealth investment mentor, speaker, and entrepreneur who has a passion for all things stock market investing, diving deep into quantitative and qualitative analysis, creating formulas and calculations that optimize stock market investing, and creating a life that fits your biggest and wildest dreams. You're in the right place if you're ready to tap into some investing strategies that aren't taught without getting a degree, working for an investment firm, and some that aren't even taught anywhere else in the world. Find deeper clarity on your investments and what your future can hold. Strengthen your understanding of recession, stocks, and your money, and learn the tools to accelerate your investments and wealth. You're here to be a visionary investor, not an average one. A passionate disruptor with uncommon goals in the investing world. It doesn't matter where you are in your investing journey. You're never too late to become a successful investor, and I'm here to help you do that. Let's get into the investing flow. Welcome to Stocks Home Run or Strikeout. What would you do with this stock? We're going to look at two stocks today. Meta, ticker symbol META, and Costco, ticker symbol COST. Now, I'm aware these stocks are in completely different sectors, but I just felt like switching it up. Stay until the end of this episode to hear my rating on these two stocks, whether they'd be a home run or a strikeout. If you want to choose a stock for the next segment of Stocks Home Run or Strikeout, send me an email to support@thevisionaryinvestor.com. Don't forget, this is a first-level analysis that you can do in order to figure out if a stock is potentially good for your portfolio and your goals or not. Think of this like a stock screener. So Meta, the 5-year annualized return has been 8.1%. The 5-year risk, which is based on downside standard deviation, was 28%. The risk-adjusted return using the Sortino ratio was 0.1. And the 2020 recession drawdown was 34.6%. So essentially during the 2020 recession, if you were holding Meta, based on daily close, you would have noticed about a 35% price swing. The Glassdoor rating, only 54% of people actually approve of the CEO, and the company rating overall was 3.9 stars. So their ESG rating, which is environmental, social, and governance, showed that they were aligned to keep global mean temperature to 1.5 degrees Celsius. However, they do get the worst possible rating, which is a triple C, among the other 23 companies rated in the interactive media and services industry. And again, that's from MSCI's website, specifically MSCI's ESG ratings and climate search tool. Now, EPS, earnings per share trend. So we noticed that Meta's EPS increased from 2020 to 2021, but then it decreased from 2021 to 2022. Next, we're going to look here at Costco. Their 5-year annualized return was 20.8%. Their 5-year risk, which again was based on downside standard deviation, was 14.8%. The risk-adjusted return was above 1. It was 1.05. And the 2020 recession drawdown, get ready for this, 13.4%. To put things in perspective, the S&P 500's drawdown was about 33.9% during the 2020 recession. The Glassdoor rating, 83% of people approve of the CEO, and the company's rating overall was 4 stars. Now, MSCI, the ESG rating, Costco was misaligned to keep global mean temperature below 1.5 degrees Celsius. They're at about 2.3% degrees Celsius. However, they are average, and they were rated A among 44 companies in the retail, food, and staples industry. Their EPS has actually been increasing year over year from 2020 to 2022. All right, so how would I rate these two stocks? First off, Meta. Now, I'd actually say this is a strikeout, and here's why. The loss from Reality Labs has been increasing each year, and it was a loss from operations of $13.7 billion in 2022. On top of that, while Meta's definitely innovating, and you can definitely see that through Threads, and they're focusing on growth, in my opinion, the risk is too high. When we're looking at the downside standard deviation, if we see a risk over 20%, then you want to look further into how management is handling the company. And given that the CEO gets a pretty low rating, and on top of that, we noticed that there are issues on MSCI related to management. So when we dig a little bit deeper and we see and think about the layoffs as well that happened in 2022, in my books, this is all pretty unfavorable. Sure, could this stock do very well over the next couple of years? Absolutely. But for longer term sustainability purposes and overall looking at the picture of what's going on, I definitely would give this a strikeout for the first round. Costco. Costco, in my opinion, is a different story. I'd actually give this a home run. I really like Costco's risk adjusted return being over 1. On top of that, the recession drawdown only 13.1%. That is really great. And strong ratings, 83% of people approving of the CEO. That's really good as well. I think overall, Costco has been doing a great job innovating. They've been doing a great job gaining market share. And this has really been shown by their bottom line of their EPS growing year over year. All right, everyone. Thank you for listening to the podcast. Kindly subscribe and follow us on all other platforms at The Visionary Investor. Hope you have a wonderful day.